5 very high growth stocks that I'm either tracking or invested in myself. Let's get started. What's up, everyone? My name is Ale and welcome back to my world of stocks. So let's go ahead and kick things off with one of my personal favorite growth stocks, and it's actually a stock that I'm invested in myself and I've been invested in for a very long time, and that is of course Amazon, ticker symbol AMZN. And because they've performed so well in recent history, Amazon has actually climbed to be my second largest stock in my entire portfolio. In fact, they are currently up by pretty close to 500% in just the past 5 years, already up by almost 30% this year alone, and currently sit near the top of their 52-week range at over $1,900 a share. Of course, this has led to a pretty ridiculous valuation, trading at over 80 times their trailing earnings. However, this is a growth stock, and for that reason, their forward PE ratio drops by 30 points, all the way down to 50, and when factoring in the next 5 years of expected growth, their PEG ratio sits at a very attractive 0.76, at least according to Yahoo Finance. Again, Amazon is very expensive at these levels, but there is at least a reason for it. When looking at their sales, they've now climbed from $107 billion in 2015 to more than double that amount at over $233 billion last year alone. That's an insane amount of money, yet they're still growing at around 30% a year, which is very impressive. And while the company normally throws much of their profits right back into the business so that they can continue dominating, even their bottom line has been soaring lately, with net income surging from just $600 million in 2015 to over $10 billion last year alone. That's an increase of over 1,500%. And their free cash flow has also grown by over 200% over the past 12 months year over year. Now, looking forward, Yahoo Finance expects their sales growth to slow down in the coming years, but still puts their estimates at about 18% over the next couple years, with their earnings growth at 36% this year, 40% next year, and then skyrocketing to an average of 94% over the next 5 years. That is extremely high earnings growth. Keep in mind that they usually beat those estimates too, with their last quarter alone seeing EPS surprise of about 50%. And overall, I think Amazon's future looks very bright for a few different reasons. In the US, Amazon only controls about 5% of all retail, while only 10% of retail was even done online last year, yet the market was still worth over $500 billion, and that's expected to climb to almost $750 billion by 2023. And that's just in the United States. Globally, the market is expected to climb from over $3 trillion this year to almost $5 trillion in 2021. In other words, there's plenty of room to keep growing just in the e-commerce market alone. Yet Amazon has several other growth drivers as well. Total spending on cloud infrastructure last year was over $80 billion, and Amazon Web Services controlled over 30% of that market at over $25 billion, which was a year-over-year increase of almost 50%. They've also seen strong growth in digital advertising, which is a growing market of its own that is expected to break north of $500 billion in just a few years. And that's not even counting all the other areas that Amazon is competing heavily in that we don't even have nearly enough time to cover in this video. Needless to say, Amazon is already a giant beast that will only get bigger in the future. And if I had to bet on which company is going to reach a $2 trillion market cap first, I would probably put my money on Amazon. Okay, moving on to stock number 2, I'm gonna have to go with what many refer to as the Chinese version of Amazon, and that is of course Alibaba, ticker symbol BABA, and this is another stock that I am heavily invested in myself. I believe at the moment it is, my 5th largest stock in my overall portfolio. Now, they're also heavily involved in e-commerce and cloud computing, just like Amazon, which we'll take a look at in just a second. But let's first take a look at the stock, and we can see that they're up by close to 100% in the past 5 years, and have also climbed higher this year by over 26%, currently trading for around $170 per share. And if it wasn't because of difficult macroeconomic conditions surrounding the weakening Chinese economy and the whole trade war between the US and China, I think this stock would probably be trading higher. But despite those very difficult conditions, Alibaba has still been able to grow at a very high rate, yet their forward P ratio still sits at less than 20, which I think isn't that unreasonable. By the way, I would ignore that PEG ratio because I think Yahoo Finance doesn't have enough estimates to calculate it correctly, but I think Seeking Alpha has it at less than 1. In any case, when looking at their sales, they've now grown from just around $15 billion in their fiscal 2016 year. They calculate their years a little differently, but that's grown to over $56 billion this past year. And management is guiding for that to increase to around $73 billion this following year. Again, this is during some of China's worst economic conditions, and they're still seeing growth rates anywhere between 30 to 70% a year over the past 4 years. They're also very profitable, bringing in $13 billion of net income last year alone, with record free cash flow of $15 billion. And while I'm on this slide, I'll just quickly add that their cloud computing business grew by 84% last year and is now the largest cloud service in the Asia Pacific region, even ahead of Amazon and Microsoft. Now, we already talked about the global e-commerce market, which, by the way, Alibaba does play a major role in, as they are much more of a global company than I think a lot of people realize. But just in China alone, the e-commerce market did $1.3 trillion in sales last year, and that was up by almost 24%, and it's still growing faster than the United States, yet it only makes up about 18% of total Chinese retail, so there's plenty of room to keep growing in the future. So going forward, Alibaba is definitely a high growth stock that I think will get even bigger in the future. There is a concern of them being a Chinese stock that uses a VIE structure, and what that means is that you usually have less shareholder rights and maybe a little less transparency from the company. But if those are things that don't really bother you too much, then I think Alibaba is definitely one of the best Chinese stocks that I think anybody could own for the long term. Okay, moving on here to stock number 3. We're actually going to go with a stock that I am not currently invested in. I used to be invested in them, but I ended up selling out, and I've been pretty critical of this company, but they've proven me wrong many times. And I think a lot of people forget that this is actually a pretty high growth company despite it being one of the largest companies in the world. And that is, of course, Facebook, ticker symbol FB, and they just continue to find new ways to continue growing their business. Now, taking a look at their stock, we can see that they've performed very well in the past 5 years, climbing by almost 200%, and are so far having an outstanding 2019, having climbed by almost 50% year to date, now trading in the $190 range. But despite this amazing performance, I don't think their valuation is too crazy, given that they trade for just around 20 times forward earnings, and especially when you consider their growth. This is a company that did almost $18 billion in sales in 2015 and more than double that to over $55 billion last year alone. And they're expected to continue growing in the next couple years, breaking north of $84 billion next year. Sure, that growth might be slowing down a bit, but you're still talking about sales growth of well over 20% even into the next couple of years. Even more impressive is their net income that has surged past $22 billion last year alone. That means that 40% of their sales got converted into net income. You rarely get that kind of profitability from a growth company, so those are definitely some insane margins. To be fair, Yahoo Finance expects their EPS growth to correct a bit this year and drop down by 6%, but then they think that it will surge by 32% next year and continue growing at about 20% over the next 5 years. And that's just if everything with their business remains the same, but that's not realistic when you consider their insane balance sheet that can easily fund a number of acquisitions or investments to fuel even higher growth in the future. They're currently sitting on over $53 billion of current assets, almost $110 billion in total assets, with only $23 billion in total liabilities. That means that just their current assets alone could cover all of their liabilities combined twice and still have billions of dollars left over. And that's not even counting the rest of their assets. And even still, they somehow find ways to continue growing their aging Facebook platform, with last quarter's growth topping 8% year over year for both daily and monthly users. And if we lump it together with the rest of their platforms like Instagram and WhatsApp, they now have over 2.1 billion people using them daily and around 2.7 billion people using them monthly. That's a huge deal because Facebook brings in most of the revenue from advertisements that are placed on their platforms, and the digital ad spending market is expected to grow to over $500 billion by 2023, with social media making up the majority of that market. So by Facebook controlling the largest social media platforms in the world with that enormous user base, they stand to arguably benefit the most from all of that growth. And we already talked about all of the growth in the e-commerce market, and Facebook is kind of sneaking into that market too by investing heavily in different tools and functionalities for their Facebook Marketplace and Instagram e-commerce features like shoppable posts that I personally see everywhere on Instagram, and I actually think that they do a great job of leveraging all of their user data to target products more effectively and in a less annoying way. Many of their shoppable posts often catch my attention, and they're even launching their own cryptocurrency next year, which they have high hopes for. So it'll be very interesting to see where Facebook ends up in the future in terms of growing their business and also stock price appreciation. And if I had to make a bet, I think I would bet that Facebook is going to be a lot bigger over the next decade. All right, guys, moving on to stock number 4. This is actually one that I used to be very heavily invested in. When I started the channel, this was probably like my biggest stock, and I ended up cashing in some very, very big profits on this one, but I still hold a small position for the long term, and that is, of course, AMD, ticker symbol AMD. Of course, this is a semiconductor company that designs processing chips and graphics chips for computers and gaming consoles and servers and so on and so forth. But while they are facing some short-term issues right now because of the whole kind of cryptocurrency crash, although cryptocurrencies are starting to recover now, but they did initially crash by a large amount, and that really affected AMD and also Nvidia's businesses. But they are expected to return to growth this year and especially in the next following years as well. Now, taking a look at the stock, they've been absolutely on fire, climbing by over 600% in the past 5 years, and are still up by close to 70% so far in 2019. Of course, that does leave them with an insane valuation of 124 times their trailing earnings, but their forward PE ratio really tells the whole story as it drops all the way down to 30, and the reason why is again because of high growth. Now, when looking at their sales, they grew from about $4 billion in 2015 to $6.5 billion last year and had revenue growth of over 20% in each of the past 2 years. But because of the cryptocurrency crash, they're only expected to do $6.9 billion this year for growth of just about 6%. But two things on that. Number one is that they probably should have seen sales decline this year, so any kind of growth is still very impressive on its own. And number two is that these problems should be taken care of by next year, as they're expected to do over $8 billion in sales and return to their normal growth rates of about 20%. But even more impressive is their earnings growth, as they're expected to grow their EPS by over 40% this year, over 50% next year, and continue growing at a 35% rate over the next 5 years. So that's very impressive growth. Much of that success is riding on the fact that AMD is pretty much the first to market with 7nm chips that offer competitive performance and pricing to what both of their biggest rivals in Intel and Nvidia currently offer. In the server CPU market alone, AMD currently has less than 3% market share, while Intel pretty much controls the rest. But it's expected that AMD will be able to reach 10% market share by the end of next year, while their CEO has goals to eventually reach 25% market share. That's a big deal because that addressable market is worth $17 billion, and combined with the GPU side, it balloons to almost $30 billion. For reference, AMD is only expected to do less than $7 billion in total sales this year. Meanwhile, Intel continues to drop the ball on their product releases, and their 10nm server chips are not expected to release until the first half of next year, while AMD is already releasing 7nm server chips, 7nm desktop CPU chips, and 7nm GPU chips all in this third quarter starting this very month. Not to mention that AMD will also be powering Google Stadia and the next generation of Xbox and PlayStation home consoles. That's another big deal considering that the gaming market continues to grow by billions of dollars every single year. And most recently, they've even partnered with Samsung to license out their IP for making mobile smartphone GPUs as well. Keep in mind that Samsung is currently the smartphone market leader, even ahead of Apple and China's Huawei. For me personally, I already have a small position in AMD, and I'm not really looking to add to it at these current levels because they are up by quite a bit. But I'm just happy with the fact that AMD is expected to return to pretty high growth over the next few years, and I think that that should continue maybe a bit longer than that as well. All right, guys, finishing up here with stock number 5. You guys know I couldn't make a growth stocks video without mentioning this company, and this is probably one of the most popular stocks out there right now, certainly one of the most polarizing out there, one of the most argued stocks, and that is of course Tesla, ticker symbol TSLA. And you guys know that I do hold a long-term speculative play on Tesla, so it's definitely a stock that I own for the long term. And while they may not be sustainably profitable at the moment, they've definitely been growing their sales at a very high rate, so I would still qualify them for this video. Now, taking a look at the stock, we can see that they are flat in the past 5 years, given some really poor performance in 2019. While all of the stocks that we talked about in today's video have climbed by enormous amounts this year, Tesla has actually sunk by over 30%. In any case, this does leave them trading for less than 2 times their sales, which is a metric that we usually look at when a company is not profitable, and normally we do like that number to be a little bit lower if we can get it, but given the enormous growth and future potential of Tesla, it's my opinion that it still looks pretty attractive at these levels, especially when you consider that their sales have now grown from just $4.1 billion in 2015 to more than 5 times that amount at over $21 billion last year. That's year-over-year growth of over 82% last year. Of course, the real issue for Tesla is again their profits, as they lost almost $1 billion of GAAP net income last year, but in their defense, they are still a pretty young company in the early stages of growing their business. Speaking of which, there's plenty of room to keep growing in the future, given that EV sales make up practically nothing of global auto sales, yet many analysts predict that EV sales will overtake ICE sales within the next few decades, but in the US, just this past year, EV sales only made up about 2% of the market. And according to Statista, the global market will grow to more than $500 billion by 2025. China currently controls over half of that market, and Tesla is looking to take full advantage of that fact by building their new factory out there that will bring down costs and prices in the country. And if we take a closer look at that market, we can see that fossil vehicle sales fell last quarter by 13%, but EV sales actually grew by 118%. So it is just my personal opinion that anyone who doesn't think that EVs are really the future, I think is just kind of lying to themselves. And when I look at the market, I see no other competitor that has a bigger head start and a bigger advantage than Tesla, because they've invested so heavily in the technology and the infrastructure already. Anyways, looking out into the future, I have high hopes for Tesla, and definitely in terms of growth, but we'll have to just wait and see what happens. In any case, thank you guys so much for watching this video. I hope you guys enjoyed it, and if you did, please consider supporting the channel. All I ask is that you just hit that like button. It really helps the channel a lot. And if you have any suggestions for future videos, let me know. And if you would like me to do these kind of top 5 videos for maybe different markets or sectors or different types of companies or stocks, just let me know as well. And I will catch you guys in the next one. Take care. Bye-bye.